Welcome friends once again to the NPTEL module on strategic trade and protectionism theory and empirics. In last 21 lectures, we have almost done with the theoretical section of trade, but still there are other tariff related theories are left. We will take it forward in the next week onwards, but this lecture, today's lecture especially on offer curves and its connection with terms of trade. So, this is to lecture number 23, where in week number 5, where we are explaining offer curves and its connection with terms of trade, which we have already explained offer curve and its derivation, its shaped movement in detail to define the international equilibrium price or terms of trade. Now, we are emphasizing on the terms of trade which are defined through the offer curve analysis with some cases. We are now explaining terms of trade with cases. So, myself Dr. Pratap Mohanty from IIT Roorkee, attached with the Department of Humanities and Social Sciences. So, once again, what are the terms of trade? Terms of trade simply is an index of export prices to import prices into 100. Now, this is what is written here as well. The ratio of prices of export nation's export commodity to the prices of its import commodities. So, in a two world nation, terms of trade of nation 1 are actually equal to the reciprocal terms of trade of nation 2, if there are only two nations exchange, but in reality there are no two nations. There are so many nations where we are simultaneously explaining their terms of trade. Now, broadly it is explained with commodity terms of trade or net barter terms of trade. In a world of many traded goods, the terms of trade is the ratio of export price index to the import price index, and these are also called net barter terms of trade, because we are concerned with the commodities exchange. So, nation 1 export X and imports Y, the terms of trade is given by Px by Py, where P is the price index. So, we are now trying to understand ourselves that terms of trade which we have explained with the help of offer curve defined at a point or at a specific equilibrium price, where both the countries settle their transactions, and countries define the best possible contract by which they trade. So, this is the point defined in this diagram, and these are possible with the help of offer curves. So, offer curve of A and offer curve of B. If you remember, in the last class which we discussed, the offer curves have different regions to shift and have various factors for its different shapes, maybe flatter, maybe steeper. Now, imagine if offer curve is like this at the initial stage, these points get changed due to the fact that we have different price line. Higher the price line, higher the points. It is backward banding, upward sloping, but banding after a certain time. Now, these are due to higher Px by Py, is not it? Now, what I am trying to emphasize here, due to certain reasons. Now, these reasons are defined as per the following. Now, we say that if there will be a tariff imposed by country A. So, if tariff imposed by country A is there, so that means higher the tariff is usually on the imports, which you have said earlier, and we discussed this number of times. Even when imports on imports, I mean tariff is imposed on imports, or Y is attached with a T term. If tariff is imposed with imports, now the demand for in the international demand for imports actually declines. So, this has led to less price of imports in the international market. So, Px by Py actually falls, this one Px by Py, every time Py falls given the export prices. So, relatively the export prices to import price actually increases when there will be tariff imposed by nation 1 or nation A. So, therefore, there will be a shift, I mean the price line will be actually changing. So, given the tariff imposed by nation A, so therefore, the offer curve will actually be shifted. Now, you can find out this is the point. Now, it is given this, it is responsible with another equilibrium point with a new, because now the this is another line P x by P y, while relatively P x is higher than that of P y. Now, just the reverse may also happen, okay, by another country may also impose tariff if there will be retaliation. Usually what happens, the tariff is retaliated. If there will be retaliation, then again they boil down to a newer price level and there will be settlement. So, this has led to less demand, and in other country, now given this fact, the country may not able to actually willing to export less, because of the fact that price is charged by at a higher rate in domestic country, in the international level total demand is not there. So, therefore, the upper curve of country A will be shifted towards left. Now, with this we have already explained, this is P x by P y at the new equilibrium point shifted towards left and reaching at a new equilibrium point. So, let us come back to the interpretation once again. So, by imposing a tariff, the country A actually decreases trade volume by import and improves its terms of trade, but B's terms of trade deteriorates. Why is it so? Because it is less demand in the international market. Okay. In the international market, the terms of trade actually declines. When terms of trade of A increases, the terms of trade of another country actually declines. So, therefore, there will be supply changes. So, change in the supply conditions will also shift countries' offer curves around. So, due to tariff, productivity also changes. So, and due to tariff or even due to its internal factors, new innovation, new resources discovery, terms of trade also gets changed. Now, one such examples in front of us is the following. So, we have we have already experienced 1970s oil crisis issue, oil shocks, not crisis, oil shocks in the world market, especially after the OPEC formation. OPEC formation in the Gulf countries and in Middle East countries, where they form an cartel, a group, and from that they impose huge, they charge higher prices for their oil exports. Now, which has led to huge impact for the industrialized country, and therefore, the impact on the industrialized countries are expected to be imposed in a different negative manner. Actually, it erodes off their terms of trade. So, OPEC effectively decreased its willingness to trade, as I just said, which has actually presumably shifted the OPEC offer curve to the left, because of the fact that they impose higher taxes on their product, and then their exportable products are actually charged with higher prices. So, increasing OPEC terms of trade because they charge high prices, and decreasing the industrial countries one. Now, if we are saying oil is here presented in this diagram and other stops are here for the OPEC, what is really important here? Now, OPEC offer curve is presented in this offer curve, and this is the price line, the relative prices of export or import before the shock. This is pre-shock price ratio or the terms of trade. Now, based on this, then this is basically industrialized countries. IC stands for industrialized countries. Now, this stands for OPEC countries. Given this fact, the countries are the OPEC countries are now charging higher prices. So, Px straightway in this case, Px, the new Px by Py, Px is higher than that of the given Px by Py before trade, or pre-shock and post-shock prices are different, therefore, offer curve shifted towards left. Now, since the post-shock impacts are very huge, and that has led to due to post-shock impact, it's may not be charging higher, but when the OPEC was formed, so they control the supply. So, that has led to some kind of other shocks, and the parties are other parties, the importing country for the oil are ready to import it, at a higher prices steadily. Now, in this context, since we are taking oil here for the product for the OPEC country, or the offer curve shifted towards left, we arrive into a new equilibrium point. Now, so OPEC terms of trade should have actually improved. What we wanted to say here, it should have actually improved. Why improved? Because of certain shocks, whereas the industrial countries actually deteriorated, and their terms of trade have been deteriorated. So, there are some examples where we are collected the information from different books. Here is the example from 70s onwards. Now, you can see steady rise in the oil exporting countries and their prices, the terms of trade, where the industrial countries actually declined. Just the reverse, look at the differences, actually reverse. Here there is a rise, here there is a fall, if you look at the numbers. But very recently, again due to many other reasons, due to American strategy, due to oil reserves captures, and due to oversupply of oil recently, that has led to, especially 95 onwards, there has been a fall again. There are other reasons which are responsible for the trends of change in the terms of trade. But that 1970 is very important for the country, countries across the world, because the OPEC has given a strong impetus in terms of change in the terms of trade. Now, another most important argument before us to examine, especially as a case of terms of trade and their changes. Now, I have already said that terms of trade actually gets changed due to various reasons: demand side factors, supply side factors, and there are many shocks, external shocks, internal shocks, and the policy changes. Again, those reasons are responsible for change in the either demand side or in the supply side. So, this can be understood. Now, one such example can be unveiled with the help of small country nation. We have in our syllabus also we mentioned small country versus large country setups. In case of small country, first attention to a small country argument is the following: small country where we are referring to their their impact on the world prices. So, and their impact on terms of trade. And small, either their domestic demand or the kind of policies they suggest may not be impacting too much on the world prices. Usually country impact the world prices through tariffs and some certain non-tariff measures. Now, in this context, so small we mean they are capturing the world demand and world supply. So, from the small country's perspective, we are referring to the rest of the world in terms of offer curve. Now, we are saying for the rest of country, offer curve is a straight line, because of the fact that we usually take prices for different countries. So, rest of the world offer curve is straight line, because the domestic country cannot able to impact by changing certain taxes on the products they are importing. So, therefore, there is no impact on the world prices. So, world prices whatever is there from the from small countries perspective, world prices is actually going to be constant. So, that even if they are imposing like Px by Py, we are trying to say it like this. So, even if they impose that plus T tariff on imports, as a ratio this falls, but we are not trying to find out in terms of ratio directly after tax. We wanted to find out the impact of their tariff on the imports, and I mean does it have any implication on the import demand. In the world of our import demand is not going to change, or the import I mean demand is not going to change due to tariff on the imports raised by the small country. So, therefore, the prices of imports is not going to change, or the prices of Y is not going to change, because so this is going to be constant. So, when the tariff is imposed on the imports by a very small country, let it be Nepal, so it is not going to impact the price terms of trade, because the import prices is not going to be changed. So, therefore, the ratio since it is constant, since they are changing Py, trying to change Py, but it is not going to change, this the whole equation will be constant, whole index will be constant. So, therefore, the world prices terms of trade is going to be constant. So, why is the rest of the world offer curve perceived to be a straight line? I mean is one of the reasons behind it. So, now there will be number of questions, maybe in the objective as well as in the descriptives is expected to be asked. If a country concerned is a very small one and the country is imposing tariff on its imports, now what is going to be its what is the offer curve for the rest of the world, offer curve of rest of the world. Offer curve of the rest of the world is not going to be changed, because the Px by Py is not going to be changed, and this will be constant. Now, if the small country imposes tariff on rest of the world product, it has no effect on the terms of trade. So, the terms of trade is not going to be changed, as I already said. So, therefore, the offer curve for rest of the world is going to be constant. If the small country imposes a tariff on rest of the product, it has no effect on the terms of trade. This is the definition of a small country, and precisely the answer behind the questions we have raised. Now, the small country and the offer curve context, which have already unfolded, questions are like this: what is the optimal tariff for a small country? Is one of the important question. Now, first answer is no tariff at all, no tariff at all tariff reduce trade volumes, but do not improve the terms of trade. So, therefore, the small countries should not actually impose tariff, because it reduces the trade volume. Okay. If tariffs temporarily they reduce the the trade volume reduces, but it is not improving the terms of trade. So, better they should not impose tariff. So, this is also really the same point we made earlier. So, which is basically free trade is especially helpful to small and developing countries. So, therefore, the small country, now another question arises here, very important: should the small country impose tariff? Country impose tariff. There are two reasons to believe. One is it reduces volume of trade. It also reduces their consumption basket, and it is not at all improving their terms of trade. So, this is one of the very important question we must try to explain as detailed as possible. Now, the small country context can also be explained with the help of diagram, but now there are other approaches to talk about optimal tariff. We may also discuss in the next class with certain other examples. So, optimal tariff is in the small country context is a tariff they are running with. Once any tariff is imposed, their tariff must be continued within the same country. They should not change any kind of further restrictions. If they do it, it might be problematic for them. Now, look at the large country context. Now, just the reverse, in case of large country context, if they impose tariff, what is going to happen? They can demotivate the imports. So, if they impose tariff, so the prices of in the world market imports falls. So, the prices of import reduces, where Px by Py actually increases. That will lead to that's led to I mean, or that will lead to shift in the offer curve towards left for the country context. Likewise, we just discussed. If they are now large country, OPEC itself now defined as a country. Here this is the one we discussed. OPEC now is no more a single, I mean, like let it be Saudi Arabia or even earlier Iraq, Iran. Those countries are not necessarily individually determining. Now after the formation of OPEC, now they jointly take a stand and jointly impact the world prices. Now here we are saying they imposed taxes on the imports by other countries, or that impose or increase their prices of the products. So, their Px actually increases. So, they can influence the world trade. Similarly, just the reverse, if the instead of OPEC, if you are trying to explain any product, but the country is very large like India and China, especially in the hardware manufacturing sector, India is the largest importer, whereas in the software segment we are the exporter. So, and if India imposes tariff on the hardware and can able to demotivate imports in the world market and can reduce the prices. So, if the prices Y falls eventually after trade, so I mean Px by Py actually as a whole increases. So, this helps in helps largely to the large country to improve their terms of trade, and thereby can control better equilibrium price in the world market. So, therefore, it is beneficial for the bigger country. And whereas in the small country context it is not possible. I think it is quite clear from the diagram and from the arguments. So, we have already discussed all those things. Small country context is just the reverse. For the offer curve for the other country is constant, though for the small country they impose a tariff. So, thereby there will be a shift initially, but actually they cannot there will be shift of offer curve because of their movement towards restricting trade due to tax on their imports. So, but actually they cannot change the world prices. So, therefore, though the import reduces, export even export and import both falls. So, both way the small country is going to lose in the world market. So, then what is important? We have already discussed here. So, what could be the optimal tariff for a small nation? Now, had it been an optimal tariff for a large nation, we will understand differently. Now, this is what we have already explained. Now, if there is any kind of after trade or if there is any tariff imposed, we will move from autarky point to other points. After trade, we will move to other points, and due to that initially the price is 1/4. Now, later on it is half, then this becomes 1, 1/4, half and 1. We arrive into separate points and we will reach at a point where the offer curve of the country 1 defined, we already explained earlier. Similarly, the reverse is true, we need not explain it. Now, what is important in this context? General relative commodity prices with trade found at an intersection point due to the offer curves of two nations, and only the equilibrium price only at the equilibrium price is expected to be balanced, and any other relative commodity prices, quantities of imports do not equal with the quantities of exports, placing pressure on the either supply side or the demand side, lead to a disequilibrium situation, and ultimately due to the countervailing pressures that will eventually equalize the prices. Therefore, law of one price prevails, and the relative prices will be equal, and both the forces will be acting for a convergence in the relative prices. We already discussed. So, therefore, both partial equilibrium and general equilibrium analysis use production frontiers and indifference map to define the world equilibrium price, the only general equilibrium analysis considers all market together, whereas the another one does not. Changes in the market for X affect other markets which possibly impact market for X. So, general equilibrium analysis is therefore required for more complete analysis. Now, more precisely we can interpret the equilibrium volatility price in a partial equilibrium setup with simple demand and supply. We did not explain earlier, so let us explain it here. This is relative price of X to relative price of Y. Now, this is export of commodity X of nation 1 and nation 2. Now, as we have already said, if nation 1 relative price of X increases till certain time, nation 1 is going to export more. So, therefore, nation 1 we have already assumed is a net exporter, and they supply their endowments support higher production of X. So, they are higher the prices, relative price of X, higher the supply. Okay. So, this is nation 1 supply curve, relative supply curve, whereas nation 2 is just the reverse regarding demand curve. When the relative price of X increases, this declines, higher the relative prices, the demand for for nation 2, let it be net demander for commodity X. So, given that when 1/4 we have already said P x by P y is 1/4 is equal to 1/4. So, relative price of X is 4 times lower than that of the relative price of Y. Now, in this context, when this is the one, nation 1 is not exporting anything. Now, higher the price when it is double. So, 1/4 to half we have already seen the previous diagram. So, nation 1 will be more motivated to export. So, initially it is somewhere 1, now is a double quantity at this price, double the quantity. Now, when it reaches at again double, reaches at 1, so it will be motivated to export more given the demand from another side. Now, when it reaches 1, this will be here, it is again reaches more than that, the export will be again differently. Similarly, at this price, at this terms of trade for nation 1, terms of trade for nation 2 is P y by P x, it will be only simply 4. So, at 4 the country 1 demands hugely, no demands very less, because it is relative price of X is X is much higher. So, what is going to happen due to trade, X is incentivized to trade demand X is more incentivized to export more. Now, when the relative price of X actually increases steadily in country 1, whereas for relative prices of X falls in country 2, because it is just the reverse, initially it is 4, whereas it is now becoming lesser and lesser. When relative prices actually increases decreases for country 2, they will demand more, okay, because that becomes their imports, not exports. When the export prices decrease, import prices for nation 2 declines, they will demand more. Okay. So, for 1 they are exporting, for 2 they are importing relatively. So, when it reaches at 1, they will actually have an equilibrium point, and that is defined as the price equalization, and that is the point where offer curves are actually overlapping, and in one side demand supply increases, in another supply demand decreases. So, if now look at, if in one case it is below to this, what really happens? Below to this there is excess demand, because the relative price is lesser. If you simply look at P x by P y instead of from country 2 perspective, it is lesser. So, the country 2 will demand more and country 1 cannot export that much. So, therefore, higher the demand will raise the prices till a point, and the reverse is true. When it is the relative price of X is higher, country 1 is ready to export more whereas since it is higher, the country 2 is demanding less. So, therefore, it will demotivate the prices and reaching at the equilibrium prices. So, these is the equilibrium prices and this settles the relationship. The last case or last example to be explained with the help of immeserising growth rate. Immeserising growth rate case we have already started in the earlier lecture. I have shown the slide but did not explain. So, let us explain it. It was in the 50s, 57 explained by Jagdish Bhagwati in his one of his base paper, where it says that immeserising growth refers to a situation where an increase in the country's export commodity leads to such deterioration in its terms of trade, and there is a net decline in the export earning and social welfare. It says that when we export more or produce more, that lead to deterioration in the terms of trade of export, because we have much higher exports or production of the same exported commodities. So, the international price level supply exceeds demand. So, prices export prices are lesser. So, it deteriorates terms of trade and thereby export earning are lesser and consumer social welfare are lesser. So, it is paradoxical to our production. So, and largely India produces some low quality products, and the international competitiveness for the product is very low in terms of prices. So, India loses in terms of trade context. Following conditions must be satisfied for a country to experience immeserising growth rate. The first condition is the growth should be characterized by more than proportional increase in the production of its export commodity. And second one is supply of export commodity should be price inelastic, okay, so that it is willing to export more even at a reduced price. Otherwise, if they are not willing to export more, we cannot define immeserising growth rate. So, these are the conditions by which this is true, to explain. Share of its export commodity in the total supply in the international basket should be large enough to depress the prices. Export commodity prices should be large enough. This condition applies irrespective of whether the country is actually large or small. In both the contexts actually it is valid, but in other regions small or large country is more important. This is one of the finest example behind explaining the plight of the developing countries, especially Indian context. So, these are all the explanation so far for understanding export basket prices and import basket. These are some of the facts from the Director General of Foreign Trade, Commercial and Intelligence Statistics, DGCIS is one of the authentic source. You can follow our terms of trade. Export terms and import terms is clearly given. So, net income or terms of trade, net terms of trade and income terms of trade are explained. We will discuss these things in detail in our next class. So, you can see negativities attached to it. These are very important to explain. I think it is quite clear to understand terms of trade with it. We will explain the last one in this week with the terms of trade in the next class. With this, let me stop here. Thank you.